Hello and welcome. You are listening to the Investor Lab. My name is Goose.
And my name is Charlie.
Charlie, what are we talking about today? I just want to put this out there. I thought today's conversation was really interesting. It really is a topic that speaks to me as a business owner, but also so many, and it's reflecting of so many conversations that I've had lately. But what did we cover?
I feel like, from my perspective, we were kind of on the same page with an unexpected conversation, but one that I think is deep in our souls. There's something in me that's been, I suppose, thinking about or dwelling over many of the things and the idea is now the time to bring risk into the equation? Is now the time to start putting up the shields or playing defensive? Or is now the time to just go balls to the wall and really swing for the fence and not worry about the other side of it?
Yeah, exactly. And I think every situation is going to be a little different. But if the big takeaways about this in this episode, I think are going to help you to maybe assess risk in business and property and to try and cut through the noise and to be able to make sure you're making decisions that are going to support your long-term goals, plus give you short-term prosperity and enjoyment and happiness. Because I don't subscribe to this idea that we have to live a diminished or frugal life right now in order to have some lofty goal down the end of the road where it all makes sense. You've got to live life today and enjoy your current time. And you've got to, I believe in frugal hedonism and living life to the fullest every single day. But at the same time, particularly in economic environments like this, we need to make decisions that are also going to set us up to have success in the future, not just today. So we covered a lot in this episode, and this episode is going to be awesome for any business owner, particularly any business owner that is experiencing some wins at the moment, but any business owner really, and also any property investor that is wondering how to navigate a frothy market where there seems to be a lot of hype and a lot of hubris and property prices seem to be going up, and how to navigate the thinking around making these decisions to create a really sustainable business and a really sustainable property business as well. Anything else, Charlie?
I love the way you brought that in. Let's get into the episode.
Awesome, guys. Thanks for tuning in. And of course, if you like this, make sure you share it with someone. If you're whatever platform you're enjoying this on, make sure you like it, share it with somebody else, send it to a family member, friend, or a loved one. And of course, let us know if there's anything that you want us to cover on this podcast to help enhance your wealth journey. But without any further ado, let's get stuck into it, and we'll see you on the inside. Hey guys, welcome back to the Investor Lab. You're with Goose and Charlie. Charlie, how are you?
Absolutely fantastic, Goose. I must mean, well, do you ever feel like there's a collision of things in your life just going right? Like sometimes you just strike after a bit of a rut, which I admit I was in. I was facing some challenges with the banks. You feel like everything's starting to go your way. Yes, I do. It's an interesting thought though, right? Because what actually, and I know that I'm instantly digressing from kind of what we're going to talk about today, but you've got to wonder why you tend to go through phases where things just seem to line up, and why you go through phases where things don't seem to line up. And there's studies on all of this kind of stuff. You know, is it flow? Is it law of attraction? Is it and what is this on a physical, scientific, and also a metaphysical and spiritual level that causes that to happen? Because I think a lot of people, I think there's a lot of collective experience that relates to this, particularly if we look at it on a more macro basis and say, well, last year there was in 2020 there was all of the social and economic issues that came with COVID-19 that put a lot of roadblocks in place for people, and then it's almost like there's been a pent up amount of opportunity, and view opportunity in whatever way you want, whether it be happiness, joy, like pressure, basically a backlog, and it feels like the plug's been taken out a little bit and it's starting to flow, and now we're sort of getting the benefit of that in some ways, but then again in others not, because I know that you recently had some issues with lenders and stuff like that, so you kind of hit all these different loggerheads. Do you have any thoughts on any of that? I feel, for me, this is just me personally, I feel like my life is very entwined. So when one thing starts going wrong, it leads to the other. So for example, if business is good, let's say I'm making more money, well then I get to buy more property. So it's like, oh, I'm winning in two areas. And then as I'm buying more property, it's like, well, suddenly I'm happier from the property, and there's a knock-on effect that I'm
spending better time with my partner in the evening. So then all of a sudden it's relationships, property and business are all firing and I'm getting joy and bliss from it. Because of that, I'm probably working out and looking after my health a bit better as well.
Yeah.
But on the conversion, it's like, all right, and this did happen. It's like, what if you come into work one day and your offshore team, so some of my team in the Philippines, which some of them are probably listening to this, it's like, oh yeah, a few of you have got, dealing with COVID or health issues or challenges. And then it's like, oh no. And then there's like, dealing with that means working bigger days to reorganize work or hiring extra resources to help cover that work. And then, okay, well, that means that I'm working more hours, so I'm not going to be as focused on my health. So then it's like this compounded losing effect. So the synchronicities and intertwining of all the activities in my life have become very apparent.
Yeah. It is interesting. I think you need to actively compound your wins. Like, I think you can't passively compound your wins. I think if you're passive about it, you may find some wins compound and then some losses compound, and then holistically you're going to stay, I guess, like in the middle, right, on a median band.
Well, I had a mentor very early, and he says if you expect to be always winning, he's like, you're constantly going to be very upset with that. Like being able to deal with the cycles of life, like everything in our life is cyclical. We have seasons, we have boom markets, we have bulls and bears and all kinds of things. It's like that side of it is a different skill set. So being able to deal with challenges and knowing it will pass is a very healthy mindset to take into things. An expectation to always be winning only leaves you with the opportunity to be absolutely let down by that.
Yeah, totally. But I think it's, I 100% agree. Like, beauty is only ever in contrast. But I think that you need to, my point is that I think you need to actively compound your wins. I think a lot of people have wins and then go, yes, that was a win. And they celebrate it. And they forget that what they need to do to strategically play chess, not checkers, is they need to go, oh, that's awesome. How do I compound that? So how do I turn that win specifically, not passively, but how do I actually take that win, turn it into another win, and how do I then turn that win into another win and try and manufacture that? Because I think like the difference between people like Richard Branson, for example, who's got 200 companies and 15 of them are over $1 billion and, all of this kind of stuff. And he owns an island and Yahoo is like, he's a figurehead for like freedom and entrepreneurship and all this kind of stuff. Like at the end of the day, he's just a guy, right? He's just a dude. He's not from outer space. He doesn't have 3 brains or anything like that. In fact, couldn't read, couldn't write. He didn't even know what net profit was until about his 20th year in business. He had no idea between net and gross, which is really, really fascinating. Just didn't understand the terms. So you've got an average guy who hasn't done anything special except compound wins, right? And I think that compounding your wins is actually the key to why some people get so much further ahead, because they're constantly going, how do I take this gain and how do I gain on the gain, rather than going, hey, I've got a gain, woo, let's use it and have fun with it. But they're forgetting to play a longer game.
Don't you find it interesting? I find these topics so fascinating. Is like Elon Musk is the one that comes to mind for me. Yeah. Is like he had a massive exit on PayPal.
Yep.
And it's like, why do anything? Like most people would do nothing after that point. So, and then he's done, no, I'm just going to completely risk it all and compound that win into another one.
Totally. The antithesis of that is Tom from MySpace. Do you remember Tom from MySpace?
Absolutely.
So
Tom everyone was you had to be friends with Tom.
Everyone had to be friends with Tom from MySpace, right? So he sold MySpace. I can't remember how much it was for, but it was for a lot of money. And that's it. He hasn't done anything else. He travels the world. He does photography because he's got all the time in the world. His photography's gotten quite good and he's starting to get known for his photography. But hey, he's just like, hey, he's got a camera, travels around, takes photos, and just living life, right? Now that's an example of using the win. Cool. He got the win. Now he's using it, and it's great.
And I hope he's very happy. By the way,
it sounds awesome. I mean, like
don't
get me wrong. If someone gave me $200 million, there would be a part of me that would be like, okay, so what do I do now? Just like get the boat, sail the world? Like, is that it? Game over? And I just go and live life and do that. The other part of me, though, would probably get very bored with that pretty quickly. And so and then you've got the example that you use of Elon Musk, where it's like you get the same amount of money relatively, and then go, okay, what am I going to do with this to compound the wins? And now he's, one of the richest men in the world. Not that being richest person in the world is the goal, but the point is that there's 6 or 7 gradients beyond exponential. Did you know that?
I didn't.
Okay, so everyone knows exponential, right? Because they see these kind of J curve growth charts of like, all these startup businesses that have become unicorns and all of this kind of stuff. And the general premise of exponential is the quantum times by itself, right? So 10 compounding on itself over and over and over, right? And so that's what gives you then an increasingly large amount of number if you've got that's why compound growth works. But where it gets really interesting is as you start to compound on compounding, you go into all of these other gradients that are actually beyond exponential. And that's, they're like heptation, sextation, pentation, all of these different gradients that are actually steeper and magnified faster and further than exponential growth, which is just fascinating. And so I think people think that there's a limit when there actually is not a limit. And all you need to do is to think about how to compound on the compound.
I like it. I like it a lot.
Totally. So it's a good little good time for us to maybe start getting stuck into the topic we want to talk about today, because one thing that I have noticed is that a lot of businesses seem to be going pretty well at the moment.
Likewise, I noticed the same.
And also the property market seems to be going pretty well at the moment.
Seems a bit intertwined, like my life.
Totally. And the interesting thing is, as I kind of mentioned at the start of the episode there, it's like it feels like there's been a bit of a like a cork in the bottle, right? So we had last year where it felt like everyone was banging their heads against the wall. And then it's kind of the cork's been unleashed. And now we've got this flurry of activity. Now, there's a lot of macro reasons for that. There's there's obviously stimulus packages and all of this kind of stuff. There's pent-up excitement, pent-up consumer spending, consumer sentiments increased, all of that kind of stuff. Well, what that's doing is, I think, creating a bit of a sugar high. Now, very interestingly, Netflix recorded 90. So their target subscribers for the next quarter, or this quarter, they've had a 90% drop off from their target new subscribers per month, right? And so they're an example of a business which, accelerated rapidly through the COVID-19 period, but essentially got a bit of a sugar high, and now they're coming back. They're reverting to the mean, basically. And so I think that there's an element that is happening of that. There's an element of that's happening with businesses at the moment, which is fascinating, because then as a business owner, you've got this interesting opportunity where you might be making more money, business is growing and all of that kind of stuff. But the question is, does that mean that you should be going and buy property because property market's going well as well? Should you be diversifying? Should you be investing back in your own business? How should you be thinking about that? How long is this boom going to last? There's a lot to unpack here. So what do you think about that, Charlie? Where do you want to go with it?
Yeah, it's a fascinating idea. Keith Cunningham comes to mind, which I think is one of the great authors in the business space. And he has this idea, he calls it, which is the bathrobe theory of business. And he's like, you never know who's swimming naked until the tide goes out. And he goes, that's, as we heard, I think it's Warren Buffett who said this, is a rising tide floats all ships.
Yeah.
But it's when one goes out is you only realize who was playing with what risk and how they were playing it. Now, inevitably, in every business cycle, we see major moves. We see many people go under. And I think my opinion here, and this is my opinion, I'm not saying it's true, is there's a tendency to get reckless in boom times. And there's a lot of operators right now that are confusing luck and timing for skill. So bad business management will be the undoing of a lot of businesses in this cycle, is my opinion.
Yeah, I think the same thing is true with property. I think the same thing is very, very true with property, because at the moment you've got a lot of businesses that have got a lot of tailwinds, and businesses which ostensibly don't have strong foundations and a lot of structural integrity or good business operation skills, business management skills, they're suddenly making a lot more money. And the reason they're making a lot more money is because of pent-up consumer spending and increasing consumer confidence. So business is roaring back to life, which is very exciting. And everyone's starting to go, oh my God, I'm having record months. Woo, yeah, we're making all this money. And that's great. But as you said, a rising tide lifts all ships. But and then as you never know who's swimming naked until the tide goes out. And this is very, very true. The same thing goes with property, because in an environment where it appears that you could throw a dart anywhere in Australia and buy a property and it would grow in value, it's kind of true. Like, it's kind of true. You probably, on a short scale, you would probably have a hard time completely stuffing it up right now. However, that is driven by a sense of FOMO, hubris, optimism, and stuff, and fun. And if you're investing in areas that don't have strong fundamentals and economic credentials, then what's actually going to happen is that those prices will revert to the mean. And so you might actually find yourself in a position where you've made a big mistake. And I think there's a lot of parallels with business and property in this specific environment.
So let's pretend you don't have a government job right now, something so secure and steady that, anything can happen and you're staying in it. The direct question I'd love to know your opinion on, Goose, is now the time to actually play semi-defensive or to put the shields up or start optimizing for survival instead of maximum gain?
I think so. Yeah, I actually do. So let me talk to the business owner quadrant for this, because I think it's really I have the benefit. We have a lot of business owner clients. We have a lot of non-business owner clients too. So I get to see a broad spectrum of profiles in the space. I think that a lot of business owners are potentially and this is someone who, like, we have a business that helps people invest in property, right? So I have a vested interest in people buying properties. That being said, I think that a lot of business owners specifically, are running the risk of taking their profits when they should be investing back in their business to build a better machine. Because I think a lot of businesses, like, for example, if they're making suddenly $100,000 more profit, it's very easy to go like, oh my God, I've made an extra $100,000. Hey, let's just go start funneling that towards property, which on the one hand makes sense from a defensive maneuver because you're diversifying your risk. And so you're saying, hey, cool, let's take some of this money and let's put it into real estate so that we've got a diversified wealth base and alternative cash flow streams and all of that kind of stuff. And that makes total sense. But if you are overcooking it, so for example, if you've made a $100,000 gain and you go, let's just put $100,000 wholly into real estate, and then you make another $100,000 gain and you go, let's put $100,000 wholly into real estate. And if that is your only play, then I would suggest that it is no longer a defensive play and you're actually exposing yourself to structural risk within the business. Because in an environment where you can make gains, you should take a proportionate amount of your gains to diversify your risk, but you should also reinvest in building a better beast. So, for example, in that scenario, you might actually do better to invest in diversifying your client acquisition strategies, to employing more team to better serve clients, to innovating your product offerings, all of that kind of stuff, so that if and when the fortunes of the economy turn, and I say when, not because I'm thinking they're going to turn in the next 12 months and the whole economy is going to collapse and this is all just a fake high. I think we're at the start of a really, really, really strong growth cycle. Like I do. That's my position. I think that in a general sense, we're at the start of a macro upswing for the next few years. Right. So there's a lot of opportunity to make gains. But I think
it's easy to get stupid in a few years.
It is so easy to get stupid in a few years.
And I'll only speak for me, but I'm sure there's many business owners that would relate. I'm pretty sure I want to keep making money for more than a few years as well. So unsustained profits, it's one thing to make money, but to keep it or keep it sustainable is a completely different game as well.
Yeah, totally. I think a lot of people confuse the way that they think about their business metrics, right? So if you have a standard operating profit of 30%, right? If you've got a net margin of 30%, for example, and then all of a sudden your business has a 70% net margin or a 50% net margin, does that mean you should take 20% off the table and go, well, I guess it's just bonus? What that would say to me is that something about the business dynamic has changed, and therefore you need to readjust your expenses in order to make sure that the machine is still operating its maximum efficiency. If the maximum efficiency and the best, service components and all of that kind of stuff equate to having a 30% net profit, it's very unlikely you're suddenly going to jump from 30% to 50% net profit and for the machine to still be working the way that it should. Okay, so you'd probably need to reassess that and go, okay, well, maybe I was making $500,000 and now I'm making $1 million. But you kind of need to rebalance your margins as a way to do a head check to go, are we keeping enough in the business or are we just taking it all out?
I thought I've been having a lot lately around this topic is the world's just gone through a big change. I don't think anyone's going to disagree with that.
Yeah.
I really look at this right now and say, how many businesses are not investing in innovation, right? Because I'm in media, and in the last 12 months, the technology that's now running through our industry is dramatically better. And so very few are using it. And I really wonder, for the businesses that are clever enough not to spend their profits foolishly at the moment, those who choose to invest in innovation and building war chests and things like that, I think are going to be far better off on the long-term scale than becoming overly optimistic with AMGs or high-risk property investments or cryptocurrency.
Yeah, for sure. But it's really interesting, right? Because you say innovation, and a lot of business owners will be like, oh, but we run an engineering firm, or I'm a coach. Maybe I run a coaching business. What kind of innovation can a coach do? Right. And so innovation sometimes, I think, gets misinterpreted by people as, I guess that means that we've got to invent some kind of space satellite, and we've got to try and reinvent something. Well, it doesn't necessarily mean that at all. You can have business model innovation, or you can reinvest in structural integrity innovation in the business. So, for example, if you were running a coaching business, for example, and you've been making good money, but you've essentially got dancing bear syndrome, which is that the only way the business makes money is if you show up and do the dance and do all the coaching, and you can't step away from the business because it's got a cult of personality, and you're a godhead in the business, and it doesn't work if you don't show up. You get sick, you don't work. You don't make money. Your clients leave, they're unhappy, right? So a way to innovate in that model would be to go, okay, well, I was making 50 grand last month, and now I'm making 100 grand. Instead of then saying, hey, I'm going to take that 50 grand and put it into real estate, which actually could be fear driven, because you might be like, I don't know how long this is going to last. Quickly, let's just try and invest. Actually, maybe if you spent that $50,000 to go, okay, I actually don't know how to build out processes in my business or how to codify the coaching that I'm doing. Maybe I could hire a consultant or an assistant or someone to come in and help me to codify that, so that I can get make $100,000 months consistently and over again, and it's not going to rely on me being in the business. And that is a way to build better structural integrity in the business. Now, one of the things that I think is very interesting at the moment is the impact that the unemployment rate is having on businesses, because unemployment rates are low, and that's good for the economy, and businesses roaring back to life and all that kind of stuff. But it means cost of team is going up. But also, as the cost of team is going up, there's also that's actually driving increased consumer spending, which has an interesting cyclical effect on business, because then people are earning more money, so then they spend more money. And so, for example, maybe the person who couldn't afford to get a coach can now afford to get a coach because they've got a pay rise because there's more competition in the job market. And then also that drives up things like property prices as well. So there's an interesting flywheel effect there as well, where as the cost of team goes up, but also so does the velocity of money as well. So there's this interesting balancing act and game that I think needs to be played there as well.
Yeah, it's a fascinating thing. I just wanted to share quickly some unique innovations I've seen, because I think this is a really interesting topic. I did something crazy during the lockdowns of Melbourne, is I actually bought a caravan. So I purchased a caravan. I was like, right, I'm getting ready for doomsday. No, I've always dreamed of doing caravanning. It was a unusual purchase for the timing, but I've always wanted one. So I won't say it was too sporadic. But I actually bought the caravan. What makes it crazy, this is the crazy part. So I'm in Melbourne, Victoria. I bought the caravan from Queensland, sight unseen, and the guy actually did a virtual tour of the caravan and sold it to me via video call. So I know you mentioned before like engineering, but I'm like, it doesn't get much more, I don't know, we'll call it bland than a caravan dealership. It's a pretty stock standard business model. And they're investing in technology to live stream and sell caravans so people can see them and experience them online. And I go, that's so unique. I had friends who are in the events industry who are now live streaming events and in person and combining the two as well. So if you're in any type of industry that once upon a time you relied on that in-person factor, you could be the one in your industry that starts to innovate that, and there's huge potential gain for it. The second one I'll say, and this is the other one, is like I think software is the other area where businesses should be paying more attention.
Yep.
You're probably spending too much time on things that could be automated now.
Yeah. And that's a really interesting point you raised, because that's actually where we're at. So
we have a very complex tech stack at the moment, and we're going, okay, how do we now automate this? How do we develop our own platforms and stuff like that? Because it's ultimately going to make life easier, but also provide a better client experience and create more IP. So we're actively investing in that area as well, which is fascinating. Because you think about real estate, and it's like, okay, it's pretty, it's all houses and stuff like that. But actually, there's a huge element that we're investing in software and science and all of these other areas in the business, which I think is really, really interesting. So, yeah, I think you raised some good points. There's like innovation can happen on loads of different fronts, and I think that the more that business owners can think about, like, because business model innovation, I think is something that a lot of business owners don't think about, and the impact that can have. A lot of people think purely around profit or cash flow, but they don't necessarily think about equity and value as well. And there's different ways to think about how much your business might be worth and what it's going to do for you too. So, for example, you could innovate your business model from a one-time service through to a subscription. And what that could do is, obviously, that's going to deplete your cash flows in the early phase, but it's going to create better cash flow continuity over longer term, and also increase the business value, which is going to give you a better equity position, and also make you more lendable by banks, because you'll actually have a healthier, stronger business with more stability, and it won't be as volatile. So there's all these kind of things that people could do now to shore up their position. So it's not all about taking more money out of the business, but if you could take a business that's earning $1 million a year in revenue and has a value of $1 million, because it's essentially a cash flow business and there's no asset value. If you could turn that into a subscription-based business, if you could innovate the business model, if you could turn that into a technology-based business by changing the access and the service and all of that kind of stuff, you could turn that from a $1 million business into a $5 million business or an $8 million business. Now, using the same amount of revenue. So whilst that might not change the amount of cash flow that you have, what that will do is change your wealth position. And then that's going to give you an opportunity to then reassess how you can then use that wealth to accelerate, like your wealth in the business, to accelerate your wealth outside of the business, which is why I think that there's a real risk of business owners playing a short game here.
Most play a short game.
Sorry?
Most play a short game.
Yeah.
There's one thing I'm certain of. Do you know what I love about this conversation though, Goose? Is there's been several recommendations and ideas for business innovation or playing business differently. And even though we're both super bullish on property, I could actually justify in certain circumstances for certain people, they would be better off innovating and over the long term would do much better than just trying to get property now because
Agreed.
of fear and a whole bunch of other things. Apart from innovation though, I want to ask another side of things, because I've been very curious about this. I've been put under scrutiny for some of my beliefs in this area. But how do you feel about minimizing risk within the business so it can be more sustainable? So I'll give you the example. This run is a great run, but no one knows when it's going to end or how long it's going to go for or how high it goes or whatever it is. So some form of preparation or buffers or war chesting is appropriate to think about in the good times.
Yep.
It really is. And I think we're in that time right now.
Yep.
How do you navigate the idea of, well, how much buffer should I put aside if I'm a business owner? Or what risks am I going to try and mitigate apart through trying to innovate my way through this or hire a team? How do you think about that?
It's a good question, and it's going to come down to risk profile. Okay, so if you are ultra aggressive and have a high tolerance for risk, you might have 1 month's worth of operating expenses in the bank, right? If you
I was having a panic attack as you said that.
Yeah. And look, but there are some people where that's okay, and the reason that might be okay is if they have a lot of trailing revenues, for example. So, for example, if they have a high amount of accounts receivable or debtors, but they've got consistent regular payments coming through and stuff, they might have a consistent enough revenue source.
Government contract or something like that.
Yeah, totally. So the premise of having, a month in there is probably maybe okay. I actually know a business owner who runs whose business is significantly large, up towards $100 million in annual revenue, who has about 6 weeks
of cash at bank. But that's because of the stability of the revenue stream. So they're like, it's fine. They've been running the business for 10 years. It's all good. Vice versa. I heard a story about the other day about a business that had like 4 years worth of buffer, right? So they were like, yeah, that's all good. We could not make a sale for 4 years and we're going to be fine. That to me is like grossly inefficient. Fat bank balances make lazy business owners, right? So I think that there's a balance.
Fascinating, right? The polarization there. And that person probably thinks they're doing, in their mind, and I'm not saying it's wrong, but it's like for them, like that's where comfortable
they were proud of it. They were like, yeah. They run a huge, big logistics company, massive logistics company. And they're like, yeah, it's great. And I'm like, wow, that sucks. That breeds laziness. That breeds inefficiency. And it's like, well, it doesn't really matter if we make any sales. Whatever. It's all good. Doesn't matter if our service goes down. Whatever. So that kind of sucks. And you've probably got a different opinion on this to me, but I think for a lot of business owners, like 3 to 4 months is probably good. The challenge with buffers is when you're in a growth phase in your business. As you are growing your business, you're growing your expenses. So yes, your revenue will be increasing, but in order to effectively scale your business, you have to aggressively invest in extra expenses, and sometimes that can come at the cost of some of your buffer. So I think it's good probably to aim for sort of 3 to 4 months, even in a growth phase. But you're going to have to assess what your risk is, because then you're also going to need to think about what if it all fails. So for example, you might say, look, we're scaling the business and we've got 2 months of buffer. But what we have built is a whole lot of unique IP. We've got a huge amount of asset value. We've got a lot of equity on the balance sheet, all of this kind of stuff. So you might have actually built a very strong business that has a lot of value, but have a small amount of buffer. And if you could assess with a reasonable degree of certainty, whether if things went wrong, you would have the ability to seek funding, whether that be through investors or convertible notes or, from a bank or some other way that you could have a get out of jail free card, then you might be able to use that as part of your risk assessment as well. What do you think?
Yeah, it's an interesting topic, particularly in the last 12 months, a very, very interesting topic. So I used to have the opinion that 3 months expenses, so you could run your business without making any money for 3 months, was a healthy place. I've actually changed it to 6. I've doubled it. The reason for that and how I look at it now is because of what I've seen and been through in the last 12 months in industry and world, and we all have. I'm not saying I'm unique. It's made me think about it very, very differently than I once did. So I moved my buffers aggressively up in the idea that 3 months in the wake of a pandemic, 3 months isn't a long time. We were locked down in Melbourne for 3 months, and I would have been severely limited on movements and opportunity in that endeavor. So I made that choice. I realized there's an opportunity cost to holding more capital within the business, but it makes me more comfortable in the other regards. Additionally, I also actually have a game plan now as well of how I approach it. So if there was an event where, and I'll put some context around this, I had several clients in the media company who ran events. They're event businesses. How they make money is events. So they ring you the week later, and I had 4 of them in the same week where they're like, yeah, we got no revenue. We can't work with you anymore. Like, we're going to have to stop what we're doing. And it's like, it kind of shell shocked me.
Yeah.
Where I was like, this could just happen on and on. So that was the trigger to do other things. I mean, thankfully, we've had a very good year in business, and like, it's, to your point, great times in my industry. But I didn't necessarily see that in the time. So after that week had happened, I sat down and said, well, if this continues, how am I going to play this? Like, how am I going to retain my key people? What other things could we do to extend our runway? How could we reduce costs? And the idea I had this is that I realized how emotional I was on the back of those 4 calls, thinking the world was going to end. I mean, clearly it's not, but that's how I felt.
Yep.
And I realized that I was actually becoming really poor in decision making.
Yes.
So I wanted to have not just cash, but a game plan.
Yep.
So to go, okay, if this happens, this is what I'm going to do. So that if the moments come up, it wouldn't be an emotional decision. It would be something that could be better orchestrated than I was. So that were my main 2. It's not just the buffer of cash, but also the game plan of how to do it. And then also what conversations need to be had, how we might run things out in just a whole encompassing series of events.
Yeah. And I think you touched on a really good point there, right?
these kind of things can drive us to have poor decision making, right? So essentially we start to operate out of fear. Now, fear can cause people to do a variety of different things, right? Usually dumb, right? More often than not dumb. So
coffee nearly came out my nose then.
But it's true, right? So in a scenario like that, so let's say you're a business owner and you've had some disruption recently. And for a lot of people, business owner or not, right, there are like the scars of 2020 are still fresh, right? So and I mean that in a literal sense, like in the emotional toll, people are still uncertain. They are struggling to think further into the distance because they're still rocked by the fact that everything changed so rapidly. And that's normal because we're all humans. So you could do a few things, right? If you're a business owner, you could operate out of fear and say, right, I'm not going to spend any money. I'm going to keep my expenses as low as possible. I'm not going to spend any money. Like, don't recycle paper clips, right? Like everyone just like keep the costs as low as possible and not reinvest and just go, I just need to build up cash at bank. What if it all goes wrong? What if it all goes wrong? What if it all goes wrong? And
you could actually cause it by doing that. Bingo, right? Because you're not balancing risk. You could just build up a big buffer and be operating out of fear. And that could actually corrode team culture. That could mean that you're not optimizing your service, all of these different things. And you could actually completely destroy your business and have the counter effect of what you're trying to achieve by doing that. So that's not the solution. The other way you could think about it is go, geez, I don't know how long this is going to last. Quick, let's take all the money we can out of it and build a war chest outside of the business and build up personal wealth. Because what if it all falls apart? Well, okay, probably if you're thinking like that. Wait, was that me? Maybe.
No, I don't think so.
It wasn't, but I thought it was an appropriate timing.
Yeah, totally. But a lot of business owners, they choose not to. Here's an interesting thing, right? A lot of business owners want to have as many variable costs as possible, right? And they don't like to hire people full time. And I think that really says something about a business. It says to me,
I think that's the worst decision ever.
Yeah, it says to me that you're expecting your business to fail. So if you want to get someone on board and you just purely want them to be on a commission only or a variable basis or whatever, what you're saying is, I have no idea if this business is going to grow or die. Therefore, I want your fortunes to be tied to the fortunes of the business because I don't want to be left holding the bag, right? And to me, I think it's you're operating out of a place of fear. Vice versa, when someone needs a role in the business, they either need a role or they don't, right? And there are some exceptions to this rule, but generally speaking, the reason a business owner might hire someone part-time is because they're like, well, we've got this thing that we need to solve, but geez, maybe we could just get someone to do it for like 15 hours a week, or maybe like 20 hours a week. And so what they're actually thinking about is, what is the specific problem now? And if we assume that we are never going to grow, then that is the only problem that we need to solve, is this 15-hour problem. However, if the business were to grow, then perceivably that same issue, whether it be bookkeeping or whatever the case may be, is probably going to become a bigger job as well. So on that basis, I think a lot of people make the mistake of trying to hedge on where they are now and going, look, I don't know if it's going to change. We might not get any bigger than this. Let's not overcook it. And I think that's a really broken fear mentality. And so you've got these kind of things where people, I think, are self-sabotaging and then they're setting themselves up for failure. And as I mentioned, people that are just going, holy crap, I don't know if this is going to last. Let's just chuck all our money into property. And I think that then causes them to sabotage their business. I think right now, like, as you going back to what you said earlier, like when times are good, is it the time to be aggressive or is it time to be defensive? I think it's about both. Like you can't have a foot in one camp or the other. You've got to have a dual strategy. So, for example, if you made an additional $100,000 of profit, you should really, like, quite literally go, okay, how do I take half of that to be aggressive, and how do I take half of that to be defensive? And I think that's going to be a more balanced approach.
Potentially. It's so circumstantial. And even as you're saying these things, I find it so fascinating in general.
Yeah.
Because I much to your point, we're talking about, like, if things go wrong here, but like, I must admit, like, even on the news more recently or in media or online, like, everyone's saying property's booming, apparently. Mm-hmm. And I think it is, but I'll say that is the media message.
It's the media message for sure. Like, it's not what's happening in the real world is not exactly what's happening in the media.
But to my point, it's easy for me to have FOMO and almost want to get in and break my own rules on the upside as well. Like there's this interesting paradigm of like, I want to play super defensive when things are bad and probably overly. And then when times are good is like overly aggressive as well. So it's that point you just mentioned about finding that balance, like the ability to make a mess of things exists in both paradigms.
Yeah, 100%. And I think that is a really good point that I would like for us to explore. And that is how to make investment decisions, right? So let's assume we've gone past this idea. Okay, so let's just say the business is going a little bit better and you got over fear and you're going, okay, I'm going to have a partially defensive and partially aggressive strategy. Then how do you then think about approaching your investment strategy when it comes to, okay, now I'm going out into a marketplace to invest and it feels like the place is booming and I've got FOMO and all of this kind of stuff. How should I be thinking about capitalizing on that? And I think this is where a lot of people are making mistakes, is that they're, as I said earlier, they're either buying in locations that don't have strong economic credentials and fundamentals, or they're buying assets that don't support the future risk profile of any marketplace, right? So, for example, people are going, oh my God, Sydney's booming, let's just buy in Sydney, but they're compromising on yields and doing all this kind of stuff. The easiest way to think about how to structure your real estate business is to look at what the institutional investors are doing, okay? So the institutional investors will, first and foremost, target assets that are at an opportune point in the cycle and present an opportunistic deal opportunity. So good price, good location, all that kind of stuff. They don't overpay. They'll never overpay. And they also have a focus on yield, okay?
I just have to laugh. I just can't see Warren Buffett buying in Sydney because, Sydney's booming. I'm going to buy in Sydney. No. Can't see it.
Well, no, partly because of his value investing principles say that a business must have free cash flow, basically. Right? A really simple format. He looks at the profit and loss in the balance sheet and goes, is it making money or not? And if it's not making any money, he ain't going to buy it. There's no way Warren Buffett would buy in Sydney. Vice versa, it's very interesting because Blackstone have been doing some very large acquisition fund plays in Australia. And they recently did the largest single real property transaction in Australian history, $3.8 billion.
That's so awesome. I love that.
It's so good. It's so good. And it was an amalgamated group of logistics properties. So FMCG logistics properties, warehouses, freestands, stuff like that had accumulated a bunch. Always really good tenancies and all that kind of stuff. Now, the way to assess the viability of that portfolio is based on its ability to support its own debt. Okay, so they'll take a long view. So typically, any Blackstone fund is a 10-year play. That's a typical structure of a Blackstone fund. It'll be, and so for everyone's benefit, Blackstone is one of, if not the largest private equity firm in the world, and I think the largest single real estate investor in the world. And they're a behemoth, and it's a very fascinating story. But their funds, so what they'll do is they'll raise a fund. They'll say, hey, guys, we want to go and create this fund. And in this fund, we're going to buy logistics assets, for example. And so they'll raise a bunch of capital. And then they'll say, everyone who puts in your money, you're not going to be able to get access to it for 10 years because they will need to take a longer term timeline to it. And then what they'll do is they will buy assets, regardless of whether it's logistics or not. They will buy assets that are going to be able to produce a profit on the way, right? And also use market forces to create gains, right? So, for example, they'll play cycles, so they get growth, but the assets must be based on yield. So whether they be buying businesses, the business must produce enough free cash flow that it's not going to corrode the investor's capital. If it's real estate assets, they must produce a high enough yield, which is typically why institutional investors often look for large-scale commercial, because large-scale commercial typically has lower yields than small commercial, but those yields are still going to be high enough to cover the cost of debt and operating costs of the fund, so they'll be profitable along the way. And I think that people can learn a lot from that, because when it really boils down to it, there's a couple of principles there. Okay, let's take a 10-year view and let's make sure it's cash flow positive. And I think if that's a model that we can all use as we're making these investment decisions in these times, I think that's going to serve as well, because at the moment yields are going down, broadly speaking, across the market because prices are going up faster than rents are. So as prices go up faster than rents, people are going to get caught out by going, well, oh look, it's not that bad, it's all right, and then they'll make decisions which are going to corrode those basic investment fundamentals.
Do you know what I feel like I got slapped in the face as you said that, because I was like, maybe, and I'll say maybe, this is just a running thought. Maybe that's the whole key, is to think more of a sustainable view, is to try and remove the short-term decision making and going, okay, if I was going to pull this 100 grand out of my business, is this because I'm trying to make a quick buck, or what's actually going to get the best return long term? Like if I'm optimizing for sustainability and ensuring this show goes on it, how would I play it then?
Yeah. Yeah, I absolutely think that, because if you're thinking, if your viewpoint in your business is, geez, this could fall over in this whole business, I don't know if this is going to last another 12 months. I'm going to go invest in real estate. Probably the wrong play, right? Because you're going to be making investment decisions based on short-term potential or short-term perceived opportunity. There's no guarantee that opportunity is what you think it is just because you perceive it in that way. And so what we need to do is we actually need to go, okay, so the market is a little frothy right now. How do we make investment decisions that are not based on the froth? Vice versa, just in the times where markets may be somewhat depressed. So for example, I don't know, like, Sydney, from 2017 to 2021, the Sydney market was down, in terms of real estate. Everyone thinks Sydney's so great, but it lost our median price dropped by a couple of $100,000 between 2017 and 2019. So it's.
Don't you find that interesting though? Where was everyone to take advantage of it?
Yeah, exactly right. So you got to make decisions based on long-term prospectus, and it's exactly the same reason that we don't advocate buying in mining towns. Now, that being said, at some point in the future, if we can advance our technology enough to be able to to work all that out, awesome. But for the general person, you've got to make decisions based on a longer time horizon. So there's no point going, where is it booming now? Let's buy there. You actually want to go, okay, where is it going to make sense for us to buy and hold this for the next 10 years? Right now, you should probably be thinking 20 or 30 years as well. But you think about it like a fund. You want to have the yields to cover it. Right, so they produce free cash flow and net profit to cover all your operating costs, and you want to take a longer term view, and that will allow you to cut through the froth.
Yeah, I like that a lot, Goose. I like that a lot. That's certainly. I must admit, I'm just looking at my calendar here. It's coming towards the end of April, right? And I must admit, my viewpoint and how I've been thinking is like, how do I make this month look great? What am I doing for this month? And it's like, how bad, or I shouldn't say bad, but that isn't the right mindset to take into what am I making strategic money decisions with for the long term.
Yeah, totally. And a really good example of that is Jeff Bezos, right? He early on with Amazon, he was just not worried about making any profits, right? And he was just increasing the asset value, increasing the user, investing in the customer experience and all of that kind of stuff. And a lot of the investors were like, dude, this thing has got to start making money. And he just refused to. He was just like, no, we're good. We're playing a longer game. Stop thinking short term. And he played such a long game. Now look, right? They're tremendously huge. Same thing goes with Atlassian. So for those of you who don't know, Atlassian is a software technology company from Australia.
The $1 billion Australian company that no one's heard of.
Oh, dude, I know. And they're like one of the biggest real estate investors in Australia as well. You know that, right? Yeah. Such good.
Fantastic company and some of the smartest people Australia's ever produced.
Yeah. Yeah. They're building $1 billion office building in Sydney. So good. I've got a lot of respect for those guys. Anyway, same position, same viewpoint they take. They tell their team and their investors, like, who cares whether the share price is up or down? It really doesn't matter. What value is the business going to be creating in 5 years' time? That's the question they are always asking. And I think if we take that viewpoint, it kind of changes the perspective of how you would approach business. It's not actually about making money, right? It's about creating value. So it's easy to make money in the short term. You just, kill all your expenses, charge as much as you can, and take the spread, right? And that's like a hustler's way of making money, right? A hustler's way of making money would be, oh my God, there's a car for sale. All right, I'm going to negotiate and get this for the cheapest possible price, right? And then I'm going to try and find somebody else where I can sell it for the maximum possible price, and I'm going to take the spread. And it's like, bam, they've made whatever, $5,000. That's a hustler's way of making money. And that works if you want to be burnt out and if you don't want to have no longevity. But if you actually want to build an empire And, and I don't mean like, I mean that in the sense of your own personal wealth empire. Like if you want to build something that is going to be able to withstand the tidal waves of economic change and cultural change and all of that kind of stuff and thrive and prosper, you need to be playing a longer game. You need to not be saying, how do I take cash now? Like, for example, rather than saying, geez, what single one move could I make today to get me the most amount of cash flow? You should actually be thinking, okay, how am I going to create longevity? What is going to set me up so that in 10 years, I can not work and also continue to grow my wealth rather than just going, for example, let's just say I got $10 million today. I could go and invest $10 million in cash flow real estate and then stop and do nothing maybe, right? So you got to think, what is going to be the continuity plan? How are you going to continue to expand on that? And I think that changes the way we should think about our business and also the way we should think about our property portfolio.
Completely, Goose. And I think that's the thought we'll round this one out on: longevity, sustainability, and being in it for the long game, playing that Blackstone game.
Yeah.
Is there any final thoughts you want to add in? Otherwise, we'll wrap this one up.
No, I think it's good. I think it's good. I think a key message from this episode is not to get caught in the hubris, right? Just because things are going well, you're not a genius, right? Chances are you're not a genius. Chances are there's tailwinds. Chances are, just in the same way that, you've experienced times where there's been economic challenges, there's economic prosperity. And what you actually need to find is a baseline. You need to be centered, and you need to make long-term decisions and make sure you're investing in both defensive and offensive strategies to get there.
Absolutely. I second that.
Awesome. Cool, Charlie. Nice to chat. Funny way to wrap up the episode.
I thought it was great. I was going to leave you hanging. See you guys.